Hi, Chris. Hi, Raj.
Hi, Mala. Welcome, Chris. Nice to see you. The moderator for the day.
So I think we are good on time, 7:29.
Perfect.
I think we'll just wait maybe another 2-3 minutes.
Okay,
Shweta has to come on.
all right.
I'm here, Mala.
Oh,
Yeah, if you can just switch on your video.
Sure, for sure.
Yeah.
Veda's joining now or later, Mala?
Actually, she joined and then got logged off.
Okay.
So
Srirati is joining?
yeah, he'll be joining in slightly late, he said.
Okay.
He has some calls back to back.
Okay.
Yeah.
I can see Suj is trying to sign in, and I think she's just, yeah, she's joined.
Yeah.
Mala, why am I on the panelist? Hi. Hi, everyone.
Hi, Mala.
Yeah. Hi, Sujata.
Hi, Mala.
Hey, Suj.
Because
Hi, Chris.
you joined using the panelist
No,
option.
the link that you sent
One
now.
second, Sujata, everyone can hear us. One second.
Okay.
Welcome, Shweta.
Thank you, Raj. Thank you. Good to see all of you.
Yeah, same here. I think, should we wait a minute or two? People are just joining in.
I think we should wait for a couple of minutes.
Yeah, that's what I was also thinking.
Yeah.
Recording in progress.
Yeah, Shweta and Chris, can we start?
Sure, Mala. I'm here.
Yeah.
We have 16 participants, Mala.
Chris, everyone can hear you. You can
Yeah,
just mute yourself
that's
for a
fine.
second.
Sure.
Shweta, if you could just switch on your video, please. We can start.
All right.
Good evening, everyone. A very warm welcome to this session of Corporate Connections Chennai. So I'm Mala Ramachandran. I'm the regional chapter director for Corporate Connections Chennai. And I have with me our panelists for today evening. And this is first of our webinar series, which we are doing from the CC Expert series. We'll be doing this series once in a quarter. Once again, a warm welcome to everyone. And I would like to request our Executive Director, Rajkumar Naran, to please introduce the panelists and also start the session. Thank you, Raj.
Thank you, Mala. Welcome, guys. I'd like to introduce our speaker for the day, Shweta Kochhar, a CA by profession and a newest member of CC Chennai 1. Welcome, Shweta. And the moderator for the day, the evening, is Christopher Arvind, the founder member of CC1 Chennai, a good friend of mine. Thanks, Chris, for accepting to moderate the session. Thank you so much.
Thank you very much.
Just to stop what CC is, Corporate Connection is a global community of business leaders for the successful people. And the agenda is to knowledge sharing and learning. So we're taking this as the session of the day and to do the knowledge sharing for all the members and the community we love to, and the sharing of our expert thoughts and our wisdom. So this is one of the session which we're starting first time, and we'll continue to do more and more of these kinds. Thank you all for participating, and over to you, Chris. Thank you.
Thank you, Raj. Good evening, ladies and gentlemen. I take great pleasure in introducing the speaker of today, Shweta Kochhar, Chartered Accountant from Chennai. Shweta is just not a chartered accountant. She ranked All India number 13 in her CA final. She joined KPMG as an M&A due diligence advisor. She went on to join the world's largest management consulting firm, McKinsey in Mumbai. There she had an opportunity to work directly with the CEOs of large companies like Mahindra Finance, SBI, and Ashok Leyland. She worked with them closely with their teams on growth strategy and productivity implementation projects. Her work in McKinsey landed her in multiple offers with various corporates, including TVS Group and AirAsia. She was offered role of head strategy. However, her passion for consulting and her passion to work with India's SMEs led her to start this organization called PKC Management Consulting Firm. PKC today has over 1,500 clients in India and outside India. They have a team of over 100 professionals who are chartered accountants and management graduates. PKC primarily focuses on 3 areas. 1 is financial advisory. 2 is audits and outsourced CFO. And 3, management consulting. Shweta herself has been a recipient of Best Entrepreneur Award from entrepreneur.com. Her organization, PKC Consulting, has received the award of National Loan Liaising from HDFC Bank. Shweta has authored a very interesting book called 20 Game-Changing Retail Strategies. She is an active investor and committee member in Chennai Angels. She frequently writes in leading dailies like Times of India and Economic Times on topics relating to finance. She's a speaker at various forums, including the Madras Chamber of Commerce and Retailers Association of India. She's traveled widely across the world. She's been to countries in all the 7 continents. She's very, very passionate about women empowerment. This is a very short introduction of our prolific speaker today. Without further delay, let me welcome Shweta Kochhar. Shweta, before you start, I'd like to tell our audience that post your session, we're going to have a small Q&A session, and we welcome questions on the Q&A bar on your screen. Please post your questions as it comes to your mind. Let it be relating to the budget 2022-23, and as far as possible in the context of income tax and GST. And let's have a wonderful session, and let's have Shweta Kochhar now decoding the budget 22-23.
Thank you, Chris. Thank you for a very generous introduction. Such a pleasure to be here today. So thank you for the opportunity. So very excited to take you through some of the very impactful changes that have been brought in by the government. So let me just share screen. My screen is visible?
Yes.
Okay, wonderful, super. All right, so hello everyone. I'm going straight into some of these changes and legal change. I'd like to focus today on how that impacts businesses and how some of the problems
Shweta, your voice
crime
is
cover today.
breaking.
So is it? One second.
Yeah.
Sure. Now? Hello?
Not yet. Not yet.
Is it
Not
any
yet.
better?
Yeah, it's better now. Yeah, I think you can share the screen again and start again, Shweta.
Sure.
Yeah.
All right, so the first thing that I'd like to cover today, a significant provision on long-term capital gains. So all of us as businesses have made, whether in a business capacity or in a personal capacity, a significant amount of investments, whether it is into real estate or gold or startups, right? And across the board, this going to have a significant impact. So what exactly have they done? So technically speaking, they have reduced the surcharge from 37% to 15%, right? Legally, this is what they've done. But what does this mean for an entrepreneur? Or not just an entrepreneur, it applies to everybody, whether it's an employee and entrepreneur across the board. So what does this actually mean? This essentially means that the tax rate on any asset that from a long-term capital gain perspective, which used to be 29%, has now been reduced to 24%. And what kind of assets are we talking about? It could be any assets. You're selling land, you're selling jewelry, you're selling any other share investments, but not listed shares. Listed shares was already at a subsidized rate of 10%, but any other form of shares, right? Startup investments, anything, or cryptocurrencies again are different. But it does cover real estate. It does cover any form of art, jewelry, etc. So for all of these, the tax rate has been reduced from 29 to 24. And who is this applicable to? This is applicable to anyone showing an income above 2 crores, individuals showing income of above 2 crores. And in terms of the kind of people that it's going to help employees who have ESOPs in companies and have diluted. Many companies today have gone on IPOs and they have looked at diluting some of their ESOPs and have had significant tax impacts. And now they're going to save a whole 5% on it. People who have done angel investments and are looking to exit startups. People who have done real estate investments anytime over the last 50, 60 years and are looking to sell. All of these people are going to benefit from this provision. So one of the things that you can do is if you're looking to sell land or if you're investment in a startup, you can hold on. Currently, we're in February. You can hold on for a couple of months from 1st April, and you will see a change in your tax rate. So that is something that that all of us can actively do. Hold on registration of a land that you're looking to sell and take benefit of this reduced rate. Moving on to the next one. On the change in the rate. So like I said, 34% is the effective tax rate, which goes down to 30%. So almost a 4 to 5% kind of a reduction. Next one is on updated income tax returns. The whole picture around this from the government standpoint was that this is a move to ensure minimum government and maximum governance, right? That's what the but now what I'm going to do is dissect the change and tell you if it really is maximum governance or not. Is it something that people can actually use, and in what circumstances? So what does updated return essentially mean? It means that once you have filed your income tax return for a particular year, you actually get the chance to change the return for 2 years, right? That's a long period of time. Earlier, before this was introduced, there limit from the end of the year. Just 3 months was available with you to change the return, and now that's been extended to 24 months, 2 years, right? So what kind of people does this benefit? So some of the immediate use cases that we can see of this section will be people who are looking to get funded for expansion, because the minute a business approaches a bank for expansion, for funding, the bank will look at the financial statements of the enterprise and see declared, what kind of profits they've declared, and hence what is the tax that they've paid, right? And if the profitability doesn't match the limits of bank, the metrics of the bank, the funding will not come through, right? The financial statements play a vital role in funding. For organizations that have, for some reason, declared lesser income and today want to expand and want to raise funding, or even not for expansion, want to raise any, get the chance to declare undeclared income for up to 2 years and take advantage of better funding or funding at better rates of interest. Another use case could be situations where companies are looking to get valued, because again, valuation is a multiple of the revenue that one declares. And if they would like to declare revenue that they didn't declare for whatever reason earlier, they get the chance to. These are two use cases. There could be other use cases. For instance, if somebody in your vicinity, right, somebody that you're dealing with in terms of purchases or lending or any of this has gotten a search case, and you feel that as part of the search case, your documents are also going to get pulled. Before that happens, you can voluntarily go and declare higher income. So there are a few use cases of this, but what we need to know, significant cost. Now, what is that cost? First of all, this return can only be filed by those people who want to increase their taxes. So if today we're thinking that, oh, when we filed the return, we forgot to claim a certain exemption. Today, let me file it and claim an exemption, right? So my tax reduces. That cannot be done. So only those businesses or those individuals that want to increase their tax can file it. Return and claim a refund. Let's assume you didn't file your return, right? This is not just filing and then filing again. Even if you've not filed your return, you can actually file your return within the next 2 years again. But if you're looking to file a return that's going to give you a refund, you cannot do it. Third, if it increases the refund, again, you cannot do it. So essentially what this means is that this return can only be filed when you have taxes to the government. So my question is this really even a facility? If it is. And again, there is a cost. Most importantly, there is an additional tax cost. So it doesn't mean that today I don't have working capital. Okay, today I'm cash crunched. So let me not, declare that higher income. Let me declare lesser income today. And after 2 years, when I have better cash flows, I will add more income and pay more tax. The question, or possibility, yes, but does it come at no additional cost? The answer is no. 5% additional tax if the return is filed within 1 year to 2 years. Within 1 year, within 12 months from the end of the assessment year, it's going to be an additional 25%. And if it is from 1 to 2 years, it's going to be an additional 50%. Now I'll talk a little bit more about this, right? In terms of what is it going to be in terms of numbers, right? To make it very, very simple for you. I'll come to that. But before that, just a few other people that cannot file this return are people who have gotten a notice. So sometimes, right, there are notices issued by the department saying you have not declared this income, or you are liable to pay this tax. Once that notice comes through, then we cannot use this option. So if we think that we've gotten a notice, let me use this provision to file the return and not have the penalty, not have the other complications. that cannot be done. And a few other cases where it can't be done. I'm going to skip those. But let me come back to this part. Right? What is the additional cost of doing this? So we already discussed that it's going to be 25% and 50%. Now, to make it real, I'll give you a small example. Let's assume that a business wants to declare another 10 lakhs of income. They have declared, assume 1 crore of income and want to declare another 10 lakhs, just for simplicity's sake, another 10 lakhs. Now, the tax rate on that itself is 30%, right? So that makes it 3 lakhs. Now there's going to be interest that will come, right? Because this tax wasn't paid in the year in which it should have been paid. It is paid 1 year later or 2 years later. Now that tax will be round about another 1 lakh, given the rates that is going to be 12% plus 12%, that makes it 24% plus another additional interest on account of advance. So roughly about another 1 lakh. So 3 lakh is the tax plus 1 lakh is the interest. Now on this entire 4 lakhs, we need to pay 25%, which is another 1 lakh. So totally 5 lakhs on an income of 10 lakhs that needs to be declared. So it's 50%. The usual tax rate is 30%. Now it becomes 50%. So this is definitely a little expensive to use, but in many cases, it may be cheaper than using some of the other provisions. Now let me skip to the next part, which is surcharge and cess. I'm going to just take a minute here to explain, explain actual interest rates. Right? Surcharge and cess and all of this can be a bit technical. I'm going to simplify this for any person that's paying taxes. So what we all think in common parlance is that tax rates are 33%. For an average, of course, the rates differ, but on an average, about 33%. But the reality is that it is actually not 33%. It goes up to 50%. Big difference. And I'll explain this to you. So assume that a business has declared a profit of 3 crores. Now 33% of 3 crores is roughly about 1 crore. So 3 crores minus they need to pay a tax of 1 crore. And what the business is left with is 2 crores. So for being left with profits of 2 crores, the business needs to pay a tax of 1 crore, which is 50%. That is the actual tax rate on profits that get left with us. Now, and why does this happen? It happens because that 1 crore is not allowed as a deduction from profits before we compute the tax. If that was done, the effective rate would actually be 33% as promised by the government. This is not something which gets spoken of, but the reality is that to be left with 2 crores, one needs to pay 1 crore of tax. And this is the same, right? Still be the same. And that brings us to this particular provision that even surcharge and cess that one pays on income tax cannot expense in your profit and loss. This is similar to the concept which I spoke about, right? If income tax could be taken as an expense in your profit and loss account, but because that's not a higher rate of 50, the same concept applies to surcharge and cess. And what the government has done is they have brought this change retrospectively from 2005, 1st April 2005. So anybody who has taken this as an expense today has to reverse it, pay interest from 2005 until now. These have been a very controversial, debated upon topic. And once again, even in this budget, the government has done it. All right, I'm going to take you to another very interesting section, which is on the same lines of allowing of expenses, which I spoke about earlier, which is on, right? Most businesses have some form of interest on, on their expense side. Now, what the law says is if this interest is not paid to the bank or to the NBE, that interest cannot be taken as an expense in the P&L, which means that you'll end up paying higher taxes. So what people started to do, and like I explained, right, the impact of not taking an expense in the P&L can be very different. It can move your tax rates significantly. So what people started to do was, if they can't pay the interest, they'll take a loan to pay the interest. So then the government made, if you're taking a loan to pay interest of your earlier loan, that interest will get disallowed. So then what did people do? People started to take debentures. They started to issue debentures of their company and use the money raised from those debentures to pay the interest. Now, again, what the government has done, they have come the provision to say if you're issuing debentures to pay interest, again, the interest is going to be disallowed, right? So it's this whole back and forth happening between businesses and the government. So the main point to note here is if there is an interest amount that needs to be paid on time, by the time your return is filed, not by March, right? If you're filing returns for 21, 22, not necessarily by 31st March 22, you need to pay. By the time your return is filed, you can pay the interest, that's fine. But it needs to be paid, otherwise it gets disallowed. All right, now I'm coming to a very interesting provision. I think one of the best changes that the government has done in the past to boost domestic manufacturing comes under the Make in India initiative of the government. So you must have read, right, over the past few years that if anybody is starting a new manufacturing entity, their tax rates can be as low as 17%. Now you compare 17% versus the usual rate of 33, 34%, it's almost half. So for every 1 crore of profit saving, almost 17 lakhs, big amounts. 5 crores of profit, 85 lakhs. So this is a very interesting provision. I'm going to talk to you a little bit about how businesses can use it. Several of our clients have used this, have seen wonderful results from this. Right, before I get into this, just one thing I'd like to touch upon today is all of us, right, have set up in a particular legal entity structure. You may have proprietorship, you may have a partnership firm, an LLP, a private limited company that has been going on for years now. I'd like to leave you with this thought that the kind of entity that you have can actually make a very big difference on your tax expense. So if you're a proprietorship, right, making high income, could be 42%. And here what we're talking about is 7%. The difference is close to 25%. And for every 1 crore of profit, 25 lakhs of additional tax is being paid because of an incorrect legal entity structure. Right? So there's a lot of merit in revisiting the kind of structure that you are operating in today. And that could be one of the simplest things that you could do to save costs and in obviously legally approved manners. So I'm going to come back. Now what the government has done is introduced this section a few years ago where domestic manufacturing companies can claim a 17%. Now, who is this applicable to? The company needs to be registered after 1st October 2009. So this is not available to legacy companies. You need to set up a team and you need to commence production. So it's not enough if you set up a company, you need to actually put in the machinery and start commercial. Sorry, just give me a moment. My presentation is shown, right?
Yeah, go ahead.
Sorry about the disturbance. Yeah. Yes, so we need to begin commercial production before 31/3/23. Now, what this button has simply changed the date of beginning of production 31st March 23 to 24. This is obviously because many companies, because of COVID, couldn't import the machinery, couldn't start things. That's a simple change. But what I'm going to talk to you about is how companies can take advantage of this particular provision. Now, when we're talking about manufacturing, there is kind of work that gets covered under manufacturing. There should be some kind of conversion of product from one form to another form. The usage should change from one form to another form, and that gets counted as manufacturing. So if somebody is developing software, where these printing of books, these do not get covered as manufacturing. Cutting, let's say, large sheets into smaller sheets and selling it, that doesn't get manufacturing. There are a few exceptions. Most other things will come into the definition of manufacturing. So the question that we often get asked from clients is, I run a manufacturing entity today. Can I move to this rate of 17%? Today I'm paying whatever, 25% or 33%. So the answer to this is, this cannot be done unless you are using new machinery. So it's essential that the new company that you're setting up, let's assume, requires 5 crores of machinery, 5 crores worth of machinery investments. Only 1 crore of that can be used machinery. The remaining 4 crores has to be mandatorily new machinery brought into India. So it could be fresh purchase from domestic sellers of machinery or import of used machinery from outside. Basically, the machinery should not have been used in India before. So this is the crux. So basically, the government is encouraging new capital investments for automation. So this is the catch here. Now, the next question that we get asked again is, okay, I'm going to buy new machinery, right? 1 or 2 new machines. Can I buy it in a new entity and not in my existing entity? Yes, by all means, you can do it. As long as you're making new investments, that can be done in the new entity. Now, what has happened is that so lots of companies have actually opted for this, taken advantage of this. So what's happened is the government has come circulars to say that if the new entity is a simple restructuring of an old entity, it cannot be counted. So there's a few integrities to this, but broadly, if you're looking at buying new machinery, yes, you can certainly take advantage of this particular provision. I think I've covered most of the important parts of this. Once you have opted for this, you cannot go back to the earlier scheme. Basically, there are a few benefits of tax that you lose if you're opting for this concessional rate of 17%. That's listed here. And this needs to be opted for in the first year of incorporation. So if you are doing this, please make sure that you have consulted on your tax front, because the first year itself, you need to opt for this concessional rate. All right, another very commonly chosen topic in the budget this year was startups. So the finance minister spent a lot of time talking about gaming, virtual reality, startups. Again, a welcome move, which was extension of the tax holiday for startups. So as you're aware, the basic provision is that if you're a startup and you are registered, the entire profits that you earn will have zero tax. And this zero tax will last for 3 years, 3 consecutive years from any 10 years. Right now, the immediate thing you may say is startups are not even making profits. So where is the question of paying tax? Good point. So that is why the government has done, for the first 10 years of incorporation, any 3 years, you'll get this tax holiday. Right? And the hope is within 10 years, at least these kind of startups will turn profitable. A few other conditions to this: the incorporation should happen before 1st April 2022. So this budget has amended this to 2024. So we've got another 2 years. Should be under 100 crores. So this is clearly not for the unicorns. This is for smaller startups. Now, a few things that I'd like to touch upon here, again, relevant for, I know that a lot of the people today here are from established existing businesses. Yeah, so can an existing business set up a new entity and register itself as a startup? So the answer to this is yes, it can be, provided a few conditions are fulfilled. The first thing is, if you're a startup, you need to register yourself with a DPIIT. Right? Now, to do this, one of the conditions is there should be some form of innovation. And although we all tend to believe that technology is the only form of innovation, that is not true. Innovation can be in product, right? You may be doing a new process, manufacturing process. You may be doing a change to an existing product. So it's very likely that your businesses will. That is point 1. Point 2 is, can you move all the existing business that you run in your existing company and opt for this tax holiday is by moving the business into the startup? You can do it provided you have a certain conditions fulfilled. Now, these conditions, none of this is listed in the Act, right? The Act is very very loose on this. But as we have done this for our clients, we know that there are certain guidelines that they follow. What they say is, of the startup should be from any of your other group companies. So if you have 100 employees in your startup, only 50 of them can be from your group companies. And there should not be very apparent restructuring of the old entity into the new entity. But there are ways to, to do this. There is a long set of guidelines. But broadly, yes, it can be planned. It can be done. And this can be, again, a game-changing provision, zero tax for at least 3 years. And it's up to us, right? Whichever 3 years, whichever highest profits, we can opt for it. So we were very intrigued, right, when this got introduced to see how many people opt for it. Do they give the registration? The DPIIT, does it approve? So actually 14,000 startups have opted for it just in the last year. And in the previous years, the numbers have been lower than 14,000, but still several of them have opted for this benefit. And it is still open to a lot of companies even over the next 2 years. So I would say section to take advantage of. And one more thing is, if there are startups looking to raise money, so what the government has done is, let's say if your share valuation is 200 rupees, and if you're raising money at 500 rupees, right? Most startups have inflated valuations and they raise money at inflated valuations. The difference 300, right? Which could be, 3 crores, whatever it is. This difference 300 will get taxed in the hands of the startup. And this can be a huge burden for the startup. So what this tax holiday does is, in addition to this tax holiday, if you apply to the government, they will give you an exemption from that 300 rupee tax as well, called that angel tax, right? To exempt you from that also. So if you've invested in startups, or if you're running a startup yourself, a great section to use. So moving out of in the last 2 years, has been spent on COVID-19 treatment. So this is a retrospective change. The government has made this change from 1st April 2020, from the time it basically hit India. So if you have spent any money on COVID treatment, well, so let me split this, right? If you're an employee, it's different. And if you are an individual who's not an employee, it's different. So if you're an employee, you've spent any money on COVID treatment, and if your employer has reimbursed it, it's fully tax-free in your hands. Or by chance, if you have lost a loved one and you have received some compensation from the employer, again, that is fully tax-free in the hands of the employee. Now, individuals. Individuals, if they've received some money for COVID treatment from anybody, right? This is the difference. This is a big change. Normally, if any individual from someone and that amount exceeds 50,000, the whole amount is taxable. So gift up to 50,000 is what is considered exempt. Above that, everything is taxable. But here what they've done is on account of treatment from somebody, that is going to be tax-free. Now, according to me, this this is open to a fair amount of litigation, right? People can misuse this section. So the section actually says that the government is going to introduce conditions and rules which they've not yet done. But still, it can be open to misuse, because any amount received from anybody towards COVID treatment, towards actual COVID treatment, which again, I mean, in a country like India, not very difficult to produce, is exempt. That is one. Second, on account of death, if you've received money from anybody, up to 10 lakhs, that amount is exempt. So I see, I see people sort of misusing this. So we need to wait and see what happens of this. TDS, this is a part of income tax, which has caused a lot of compliance burden to businesses. What does TDS essentially mean? It means that you are withholding tax on account of your supplier or on account of your customer. Basically, it's someone else's tax that you are holding and paying to the government. So you are fulfilling the compliance of some other party, not yours. And the thing is, if you don't fulfill it, you are going to be the person that is penalized. So that is, a TDS in a nutshell. So what the government has done is increasingly brought more and more sections into TDS. So initially it used to be more, the service expenses. Then they brought it to goods in the last budget. And now they brought it to a new section called business promotion. Every business has some form of promotion. They either do, gold coins, or they give gifts, or, foreign travel, TVs, whatever it is, whether you give it to your dealer or your customer, it doesn't matter. There is going to be a TDS on that. So how does this pan out? What is the rate of TDS? 10%. What is threshold limit? A mere 20,000 rupees for a whole year. So anything that you give above 20,000 rupees will come under this TDS provision. So what happens if you're giving, let's say, a TV, right? You run a retail entity and you've announced some marketing campaign and you're going to give a TV to somebody, and the value of the TV is 2 lakhs. Now, 20,000 is what you need to deposit with the government. Now, the question is, you're giving a gift in kind, Okay, 2 lakhs worth of TV. Now this 20,000 has to be paid either from, see, this is a tax on the receiver of that gift, not on the company, on the receiver of the gift. Now, do you think that this company which has announced this promotion is going to be able to collect 20,000 from the receiver of the gift and then deposit it to the government? Very unlikely. So invariably, the company from its own pocket is going to end up paying that money. So the cost of the whole promotion has now become 2,20,000 and not 2 lakhs. And at scale, this can be a big, big number. So this is definite increase in compliance burden for companies. And again, how do you value? Right? One will say the value of the TV, the foreign travel, or whatever perk you've given, gift. No rules prescribed yet. My judgment is that it should be on actual expenditure for which we need to maintain documents, but there is no rule that is prescribed yet. Now, what happens if the company doesn't comply with this? Again, the expense gets disallowed. 30% of that expense gets disallowed. So if my promotion budget, let's say, was 10 lakhs for, and if I haven't deducted that 1 lakh of TDS and paid it to the government, I will end up paying 1 lakh to the government, which I anyway have to get, plus 30% of that expense will get disallowed. Invariably, I mean, final financial terms, another 1 lakh on income tax also you'll end up paying. So close to that 10 lakh budget becomes 12 lakhs because of non-compliance of this section. So 20% increase, which is a material impact. Now, who will this affect? In my opinion, all kinds of businesses. Every business has some form of business promotion, especially pharma companies do a lot of this with doctors. Any company which has a long distribution channel, right? Distributors, dealers, they have lots of these schemes, free gifts that they give, free samples. All of this will now start coming under this radar. Now, what taxing is not just for businesses, it's also for the receiver. So far what's happened is, let's say if I as an individual have received a gift, not a gift, I won I won something and I won this TV, or I'm a dealer for, let's say, Alan Solly, and because I met my targets, I'm being taken on a foreign trip. Now, whatever I get taken on today, I don't report as income. But now what I'll have to do is, let's say 5 lakhs was spent on that trip on my behalf. I have to report that 5 lakhs as an income in my books, which so far has never been done. So this has implications on the receiving side as well. Because TDS is now deducted from the company, the government is going to have a track of these transactions. And if the receiver is done, automatically the receiver is going to get a notice. So you see the chain. So that's an interesting part. Another part is, I've seen usually business promotion expense is one area where people increase, artificially to boost expenses. Now, I am not advising anybody to increase expenses to boost, none of that. But I'm just saying from an observation point of view, usually people use business promotion expenses as a line item where they, boost expenses, etc. And now that cannot be done because it comes under the TDS radar. So anyway, my gut says that increasingly every expense will start having some form of TDS or the other. Every year, one or two new TDS sections are introduced by the government. So compliance burden year on year, although they keep saying ease of doing business and all of that, but compliance burden for businesses has gone up substantially. So this is an example that I've given here. X gives a free sample, aggregate value of 25,000 to somebody. To his agent, yes, they need to deduct TDS. Yes, now cryptocurrencies, one of my favorite topics. Over the last few years, the clients have been asking, can I invest in cryptos? Will I get into trouble? Will income tax scrutinize me? All of these questions. Now, will you get into trouble? Will the country legalize it or not? That is a question still to be answered. Thing they did this year was they said, okay, all of you have gone and invested in cryptos, right? It's huge. I think almost a good percentage of the country today has some form of crypto holding. And here in virtual digital assets, it covers everything, not just crypto, NFTs, all kinds of virtual assets come under this. So the government is saying that you've gone and made money on these cryptos. Now we are going to take a good 30% of it. But at the same time, we're not going to legalize it. So if you made money, we want to make that money. But we're not saying that it is legal yet. Tomorrow we may still ban it. And whatever you are holding, may not be worth anything in this country, but we want to collect the money on it. So, that's where we stand today. So there is a flat rate of 30%. So if somebody has made a certain profit on account of buying and selling of cryptos, 30% of that. Now, what was the rate earlier? And what is the change now? Earlier, if you held it for the longer term, it was 20%. Now it's become 30%, close to a 10% increase. And if you sold it to the short term, these were the rates, depending on that's become 30%. Now, one more very important thing, right? A lot of people have actually lost money. Not everybody's made money on these kinds of transactions. So if you are one of lost money on any of these, transactions, you could have set off that loss against income from some other transaction, which means that effectively you are reducing your tax burden. If you made 50 lakhs loss here and you have 50 lakh profit somewhere else, rather than paying tax on the 50 lakh profit, you could have set it off. But what they've done is they have completely disallowed setting off of losses. And this is effective from 1st April 22. Again, because of the timing, there is a chance that companies or individuals can sell book loss earlier and use it to set off. But actually, provision comes in from 22. This cannot be utilized. But this is a big hit. Made losses. So they've made losses. They're not going to be able to save taxes also on that. Again, TDS. They have introduced TDS on these transactions, and it's going to be super tedious, to be honest, to track this. And I'll tell you why. So they've introduced a 1% TDS. So anytime you are buying a crypto and you're paying money for it, you only pay 99%. This is effective from July. So you only pay 99%. And pay that 1% on behalf of the seller. But the question is, if any of you have traded on these exchanges, you will know that how do you even know who the seller is? Right? We're buying, let's say, on WazirX or whatever, or any of who the seller is and on whose behalf are you going to pay the TDS. None of this has been answered in this particular amendment. So I see a lot of confusion, a lot of litigation happening initially here. And to implement this section, it's not as smooth as trading, right? Equity shares, because registered with SEBI, there is a fairly neat structure. Digital asset, people are trading on international platforms. Not all of them, are as neatly regulated. So it's going to be a bit of a nightmare to implement this. And again, there are some threshold limits, more than 50,000, more than 10. Dealing in these will end up having higher than these threshold limits. So they don't. They've made gifting taxable, but one of the things that we can still use is gifting between relatives is still not taxable, even if it's virtual digital assets. So if you want to neutralize your tax rates, the gifting provisions of cryptocurrencies between family will not be taxed for that, right? This is and I think we'll slowly realize this, and they will again amend that section. But until then, it is still open. Moving on to which is on cash credit. We're nearing, the end of some of the income tax related changes. Cash credit. This is.
Shweta, sorry to interrupt. I think we might have to accelerate a little bit.
Oh, we're running short of time. Oh, sorry. We've already. Okay. Sorry. Okay, let me accelerate this a bit. So cash credit in very, very simple terms is an income which gets taxed at 75%. What are we talking of? 33%, 42%. We're talking about 72% tax. 75. This is a special section under which some forms will get taxed at 60 plus 25% surcharge, which essentially becomes 75. Plus on top of that, there's interest. Basically, everything that gets taxed under this section will go to the government. Now, what comes under this section? Very, very important for all of us to know as individuals, as entrepreneurs, as employees. It doesn't matter. What happens? What kind of income comes here? One is unexplained cash credit. So if you have an income or a credit in your bank, in your book, which you cannot explain the source of, that gets taxed here. If you have made an investment or an expense, let's say foreign travel expense, investment in any land, and you cannot explain the source of that, where you got the money from, that entire amount will get taxed at this rate. Very, I would say, very high tax kind of a provision. Many people still not aware, lots of litigation. We have fought lots of cases under this. Now, what is the change that this has made? So far, this section has said that if any form of, any of this has been done, let's say cash, unexplained cash credit or investment, then you have to be able to give an explanation. But now what they've done is, if you have borrowed money from some creditor, that creditor also has to explain how he got the money. So it's not enough if you explain, your creditor also explain where he got the money from. And they've left out venture capital funds, etc. I think this is to not affect the investment climate. So a dangerous provision, I think good for all of us to be aware of. I'm going to skip this in the interest of time. Cooperatives, not so relevant. Again, I'm going to skip this. Search cases applicable to a very few people. I'm going to cover this part on GST, which is input tax credit. I mean, all of us have used this input tax credit at some point. The whole beauty of GST was seamless flow of credit. The government brought it on the promise that there will be no cascading effect of tax. If you have paid to your supplier, you will get input when you are paying the output GST to the government. But now all of these changes have heavily defeated this whole concept of ITC. What they've started to say is it's not enough if you've paid tax to your supplier when you bought something from him. It's not enough if you paid tax to him. It's not enough if you have the invoice. So the only things were you need to have the invoice, you need to have paid the tax, you need to have filed your return, and you should have used that service. That's all. Now what it says is that supplier should file his return and that input should reflect in your GSTR 2B. If it doesn't reflect, you cannot take it. So basically, if the supplier doesn't do his job of filing the return, you will lose that credit. So let's assume 1 crore of your raw material on which you paid 18% GST, 18 lakhs. Just because the supplier hasn't filed return, 18 lakhs you pay. So the government is saying, I'm not bothered whether the supplier is filed or not. If he hasn't filed, you pay. We will not forego on our taxes. Again, what is happening? Somebody else's compliance burden is coming on the business. So, so this came in through rules earlier, and now they've done a backdoor entry and put it as a section. According to me, big impact on businesses. The government simply says if this supplier is not complying, you move to some other supplier, but that's not always the case, right? Terms may not set. Buyers don't always have that kind of control on suppliers. So so there are several problems to this. In my opinion, the neat way of solving this is if the supplier hasn't filed, go after the supplier. Why are you coming after the business? So needs to be some relook at this from the government. But what we as businesses can do is make sure that every month, whoever we have procured things, they file their returns, and if they don't, we set up some mechanism by which payment to them gets blocked, or we stop procuring for them in future. And I think businesses immediately need to implement these kinds of systems in their organizations. We've actually seen a lot of this happening already, so it's a good thing. I'm going to skip this for the sake of time. If you have any questions around this, I'm always happy to answer it. Again, this is a restriction on input tax credit. We've had a lot of people coming in and saying the rate on textiles is going to be increased from 5 to 12. There was an announcement from the government, right? From 5 to 12, the GST rate is going to be increased. So there's been a lot of speculation whether it will be implemented from 1st April. So far, no decision taken. I don't know how the sort of rumors spread around this, but no decision has been taken. So until the government comes back with this, it's going to remain the same. So I think I'm going to stop. I've covered a fair amount. I'm open to questions at this point.
Shweta, thank you so much for a phenomenal presentation. Very, very impressed. Honestly, this gives a very different perspective into budget, because we've been reading the budget from the government perspective. I've listened to industry bodies speaking, but listening from you gave a completely different perspective, a very client specific, as an industrialist or as an entrepreneur, how do you interpret it? And I think that's exactly what you did, and a very bold and honest assessment of what seems right from a professional angle, and what seems to help the industry, what seems to complicate things for the industry. And we very forthrightly put it, and wish there were minds like you within the policy making team of the government. Will go a long way in benefiting everybody. But anyway, we had a fantastic session. There was one question.
Thank you, Chris. Thank you so much. Your questions coming in on the Q&A. One is, what will be family member transaction? Say husband transfers some amount to wife. Will that be considered as income for wife? So actually, I will answer this question in two parts. What is family member transaction? I will answer that separately. But husband transfer to wife, will that be income of wife? Yes, between husband and wife, there is a clubbing provision. So let's say if you are giving some money to your husband or your wife, and wife earns some interest out of it, or any other, puts it in a business and it invests in land, earns profits out of it, that whole money will get taxed in the hands of the husband. So between husband and wife, this section cannot be used. But where it can be used is in a lot of other cases, between parents, children, uncles, nephews, lots of people where they can be used, and very effective way to save taxes. So I hope I've answered that question. What's the suggested or practice mechanism to know that our supplier has filed their returns? So actually speaking, the right thing here is it should reflect in our 2B. In our particular return, the supplier should reflect. That is when we are eligible. So the law doesn't say that if your supplier has filed returns, you'll get it. No. He should have filed, and it should reflect in the 2B. Then only we'll get the credit. So how to know is simply to see if it reflects in your 2B or not. If it doesn't reflect, then it means that there is some problem, either technical glitch or supplier glitch. So then we need to follow up with him, understand what happens. So that's
So a couple of questions. I thought from the perspective of the audience here, it might be relevant. Will you take those questions, Shweta?
Yeah, sure, why not?
Yeah. So one of the things is that the budget speaks of trust-based voluntary compliance from taxpayers. Do you really see a lesser litigation and scrutiny by departments as a consequence of this, or?
I think lesser litigation hasn't honestly happened. There has been the same, if not more, of litigation, because today there's huge automation. GST is linked to income tax is linked to your brokerage transactions, income tax is linked to all the banks, to income tax is linked to your registrar office also for all kinds of land transactions. So you sell a land, automatically any department knows. And if you've not declared it, you'll get a notice. So everything has gotten automated, linked. So actually today there's a lot more litigation. Would be the honest.
That's the way you see it. The government is talking about in its budget connecting post offices with core banking solutions. Considering that the scheduled banks and PSUs are not present everywhere, but the post offices are there. So the last mile connectivity to MSME industry, will this move help the MSME industry?
Great question, actually. It was a very welcome move. So they've said that the core banking system which banks use is going to be extended to post. Phenomenal move. So a lot of the services which today post offices don't offer are going to be offered, and it's amazing use of the infrastructure that we already have. The only challenge that I see here is the readiness of post offices to be able to do the manpower. But I think eventually that should fall in place. But yes, it will definitely improve last mile connectivity of this.
Initiative from the government. The budget, the finance minister has announced that there would be an extension in the emergency credit link guarantee scheme, the ESLG, where the MSME can borrow without collaterals from banks. Will this policy, continuation of this policy, help in reviving the MSME sector, especially after the pandemic? And what do audience here infer out of this?
Sorry, Chris, I think there was a bit of a drop.
So
you mentioned emergency credit is extended. Will that help?
Exactly.
Okay, perfect. Yeah. So it's been actually the whole emergency credit, when COVID happened, a lot of people were expecting some form of tax rebate or some low cash infusion from the government, but that didn't happen. What they did was they just extended loans, which anyway companies need to repay. At that time, there was a disappointment. Actually, when it got implemented, almost 3 lakh crores of credit has been offered to startups, and that's really been, a breath of air to choking companies. So it has been very helpful. We've seen, in fact, every public sector bank, central bank, all of these we were given targets. You need to disburse some emergency credit, and they were chasing companies to take the credit. So mention of that, welcome move.
This might be slightly outside the exact budget announcement, but I just want to understand, like countries such as Singapore, the UAE, they have very minimal income tax rates.
Mm-hmm.
How does this affect the flow of money into India?
Yeah, so lots of talk has happened around this, right? And again, great question. Where there is a huge discrepancy in we're at 33%, the US is at 40%. Companies, UAE was at 0, has now brought in some tax. Huge differences in rates, and because of that, what's happened is that companies have been incorporated. So large companies, right? And all of these guys, compared to the profits that and big difference in money that flows into India versus money like or Dubai, Singapore. That's why today, this whole concept of equal global, and in fact, that is one of used the manufacturing because it wasn't enough for manufacturing companies to pay 30% tax rates and operate in India vis-a-vis operating in a China or a Bangladesh, etc. So that's one of the, and I really hope the government realizes that some of these changes will actually help the economy and improve revenues from a longer term perspective.
Absolutely. As we are at the end of the session, one last question. There was an announcement about replacing the current SEZ Act with a new legislation. What exactly is the thought process according to you? Is it to boost the exports? Are we going to have more export-friendly policies?
Been one of the very good provisions. Companies have been in SEZs, have used these provisions for export. And today they're going to revamp it, but they've not mentioned how they're going to revamp it. Just one announcement that they made in the budget was the International Financial Service Centers, which is there currently in Gujarat, right? The whole gift city. There, almost 54 banks have set base, and it's given employment to lakhs of people. Tax is again zero, fully, right? So it's very lucrative for foreign investments, foreign banks to come in and operate out of here. What they've said is they're going to set up something similar across the states. So if that happens, it's going to be a huge resource mobilizer in terms of employment, in terms of taxes, a big boost, I think, to the entity. But other than that, they're going to do.
Thank you. I'd like to thank you for.
I think there's one question in the chat box, Chris.
Let me just.
Yeah.
In the chat box. Okay,
Yeah.
I'm going to just take that for Shweta and. All right. The question is, implication of 146 recipient will get gift plus TDS is 50,000 plus TDS rupees 5,000. Which recipient can? Is it right, ma'am?
Sorry, I'm not able to understand the question.
Okay, it goes like this. Implication of 146 are recipient will get gift plus TD. Say gift value rupees 50,000 plus TDS rupees 5,000. Which recipient can claim? Is it right, ma'am? This is the question.
I'm unable to understand the question. I'm happy to take it offline though.
Okay.
I can share.
All right. So we'll try and take that offline. And there, I think with that, we come to the end of the Q&A. And Shweta has shared her email ID, shweta@pkcindia.com. So you can always reach out to her on email for any specific questions offline. As they say, knowledge is potential, but real knowledge application is power. And that's exactly what Shweta demonstrated to all of us. And if we can take what we've understood today and apply what's relevant to us, I think that'll make a big difference. Thank you so much, Shweta. Over to Mala.
Thank you, Chris. It's been wonderful. You've made the whole thing so simple for me. So thank you so much.
Thank you, Shweta. A great session on Budget 2022. Thanks for your knowledge and wisdom which you shared, and we really learned a lot about it. I have a question for you, but before that, I'd like to invite our National Director, Corporate Connections, Veda Bestin, for Tamil Nadu, Kerala, and Pondicherry. Can we invite Veda Bestin, please, as panelist?
Yeah, one second.
She's been very supportive in building that region for us, and she heads Tamil Nadu, Kerala, Pondicherry. First time we'll be meeting her, Shweta, as well.
Yeah, I mean, while she just comes in, I would just wanted to say a quick thank you to Corporate Connections, to Chris, Mala, and Raj for putting this together, and for the entire audience for such patient hearing.
Thank you, Raj, for inviting me here. Thank you so much, Shweta, for your presence today. And then it was really, really informative. As Chris was telling, this was really eye-opener for most of us. GST and the income tax is extremely important for us, but most of the things we leave it off to our, tax practitioners to take care of it. But you have really enlightened us. Thank you so much, and thank you for your time. In fact, I know it's filing time, and I know it's really busy for you, but thank you so much. It was really, really enlightening. In fact, I have a little more to ask you on the long-term capital gain, but I'll connect with you personally, and then I'll understand a little more about it.
Sure, Veda, anytime.
Thank you, Chris. The moderation was brilliant, and I think this was really apt topic, Raj and Mala. I think we should do more of these kind of things, which is absolutely necessary for our community. And as the community is growing, this becomes extremely important to share the knowledge what we all have. So kudos to Chennai entire team, and great show, guys. Thank you so much for having this amazing expert series. Thank you.
Thank you so much, Veda.
Thank you, Veda.
Kind words. I have a quick question, Shweta, if you don't mind. Just to say, a private company is giving gifts to his customers.
Yeah.
Okay, say 50 customers, 100 customers are giving gifts, and 5,000, 6,000, 10,000 value of each gift.
Mm-hmm.
Is that taxable on TDS?
If it is 5,000, 10,000, anything under 20,000, it's not taxable. It's not doesn't come under the radar of TDS if it's under 20,000 for the entire year. But if you're giving 5,000 5 times a year, then it becomes taxable.
Okay. So to one customer, about 20,000 is allowed per year. Okay.
Correct.
Thanks. Thank you so much. Thanks for this insight. Really helped a lot.
Thank you, Raj.
Thank you.
Thank you all for
Thank you,
attending this lovely
everyone.
session, and we really enjoyed having you all here. And we'll keep coming back with the next topic. And if you have any topic which you recommend, can please post us, and we can come up with those topics too. Thank you so much.
Thank you, Chris, Veda, Raj, and Shweta, of course. Thank you so much.
Thank you.
Great, Chris. Fantastic having you. Thanks, Veda, for coming.
Pleasure, Raj. Thank you so much. Bye, guys. Have a great weekend.
Bye. Bye. Thank you.